Hey, welcome back to Joshy K. So I'm Josh Kozis, licensed financial planner, and I've got a guest with me today. I've got Adam MacGregor, also known as Adam Mac. How you going, Adam?
Yeah, well, thanks, Josh. How you doing?
Yeah, good, good. So Adam Mac's a mortgage broker, and I thought best to get him on the channel, and we'll just talk about some basics when it comes to loans, what people should be thinking about. So if you're comfortable with that, Adam, we might get stuck in.
Yeah, sounds like a good game plan.
So typically, as a financial planner, I see clients come in. Some examples could be that they're looking to buy their second home, or they're looking to maybe upgrade their initial one. And I often find there's often gaps in their knowledge with just understanding the basics around how loans are structured. So be good to hear from you. I guess loans are generally broken up into two camps, I guess, and that would be your fixed interest rates and then your variable interest rates. So can you tell me a little bit more about that?
Yeah, absolutely. So, with the two sides of of loans in the residential space, and when I say residential, there's sort of, I guess, if I take a step back, there's two types of lending. You have residential, which is, purchasing a residential investment property. So if you want to buy a house to be able to rent out, or if you want to buy your own home, or known as an owner occupied, that would fall in the residential space. And then you've got commercial lending, which is, say you want to buy a factory, anything that is used for business purpose generally will be in that commercial space. But within the residential space, you've got the two types of loans, which would be a fixed interest loan or a variable interest loan. So a fixed interest loan generally goes between 1 and 5 years fixed, depending on the lender. And that's an agreed interest rate that you will be paying for the length of that fixed period. Where on the other side of it, when you're talking variable interest rates, it's as it sounds, it's variable and it's dependent based on the market rate plus the add-on rate that the lender would like to put forward. So that's when you see the RBA decision of the cash rate really does affect that. And generally, it's directly applied. So let's give an example of, say, if you had an interest rate of 5.5 and the RBA released a 25 basis point or a 0.25 decrease, your rate would go from 5.5 down to 5.25.
And that's assuming that someone's on a variable rate as opposed to the fixed rate, like you mentioned.
Absolutely, absolutely. If you're on a fixed rate, well, that's your rate won't change for that agreed upon period. Which sort of has two schools of thought there, where if the RBA brings that rate down, you don't see the benefit of that rate coming down. But on the other side, if the RBA decides to put the rate up, you also don't get hit with the higher rate, and you sort of have certainty throughout that period of exactly what you're going to be paying.
Yeah. And so do you think that's the main advantages between the two? So I guess as a broker and also as a planner, we don't necessarily recommend which way people go. It's up to their personal circumstances. But yeah, how do you frame up, I guess, the pros and cons of picking one over the other?
Very much how I just sort of put it, where a pro for a fixed rate is you've got certainty in your repayments. So you'll know for that time period exactly what you're going to be paying. But you do run the risk of if the rate does come down, your rate won't change irrespective to the actual way the market's moving. So as a personal perspective, I generally recommend a variable rate. Just from the side of you can take advantage of the market moving. And at the moment, with the way that the RBA has been changing interest rates of late, people are generally taking advantage of that. But there's also people out there that do live a surety, and I have written some fixed rate loans where they'll go, okay, I know for at least the next 2 years is probably the best example. People generally lock in for a couple of years. That I want to know exactly what I'm paying so that I can have a fixed budget, and they really see an advantage in being able to lock it in for that, and are willing to take the small risk of, okay, if the interest rates do come down, I might not take advantage of that, but I'm happy with that, knowing exactly what I'm going to pay.
Yeah. So I guess knowing how often the Reserve Bank of Australia meets the RBA, the likelihood is that they'll either raise, retain, or decrease the cash rate. A lot of people are making that decision based on that. Do you find there's some common examples of, so you've just mentioned they want the certainty, but why some people want certainty? I mean, some that come to my mind could be, you're about to start a business and maybe you've got those variable expenses coming through. So you want to know that your mortgage is at least going to stay the same so you can budget your household.
That's a really good example of one. And I think the other one that really comes into it is if people are wanting to start a family. And the variable expenses are going up and down with bringing in extra child into the into the family and having another mouth to feed. So generally, they want to know what their fixed expenses are so that they can budget around that.
Yeah, and I suppose particularly if you've got one partner who's not working, so maybe you've got a household decrease in income. So you're like, look, even though we might pay a slight premium if rates change, I need to know that my mortgage isn't going to go up significantly because I had it on a variable rate.
100%, 100%. And that's generally where those sort of 2 year period comes into it. Because if you're bringing, say, if your partner wants to be a stay-at-home mother or a stay-at-home father, depending on which way your family wants to make up, having that interest rate fixed because you've gone from a dual income household to a single income household can be quite advantageous for people.
Yeah, I suppose the other one looking at it as well would be if you've just been renting for the last couple of years with your partner and you've just bought your first home, sometimes because you're used to paying your rent and having it the same for the duration of your lease without it changing, and then it gets reviewed at the end of that, sometimes it can make sense for people to also fix a rate for that first year just so they get used to the mortgage repayments. Because I think
Absolutely.
if you were renting a house and some weeks you were paying 450 and then you went up to 475 and then it dropped back down to 450 and every time it was changing in line with the cash rate, you'd be like, gee, I just need some consistency with this rent I'm paying. So I think sometimes, yeah, when you transition to that home ownership, it can make sense for some people to consider the fixed rate.
100%. And I speak from my personal perspective. When we bought our first home, me and my partner, back in 2019, and interest rates were far lower than they are currently. This was pre-COVID. And as a result, over the years, our mortgage repayments almost doubled.
Yeah. Yeah, that was a big shock for a lot of people, I think, when the COVID rates chopped off, particularly in the last couple of years. Some people did fix them for a bit longer, but yeah, so it's actually been quite a while ago. And there was a big drop off with even people who did 5-year fixed rates, which was fairly uncommon back then. You're seeing all of those shifting over the last 12 months of them be going to variable. And like you said, going from maybe a 1.99 or a 2.29% interest rate up to, 5.5.
Correct. And overnight, all of a sudden, I mean, to give you an example, this is more about a Tasmanian-based example. On a mortgage of it was about 220,000. Repayments used to be about $900 a week. Oh, sorry, $900 per month, and those shot up to about $1,700 overnight.
Yeah, big shift. Yeah, and I suppose there was also, I heard, it didn't happen to me personally, but people getting locked in because they're part of a fixed rate where they might have not had enough equity in their homes to refinance to get a better rate as well. And I guess that's to do with the loan to value ratio. So probably worth spending a little bit of time just talking about what a loan to value ratio is.
Well, LVR is usually a term that you'll see kicked about within the banking sector if you go for a mortgage. And as you just alluded to, Josh, it basically stands for loan to value ratio. So essentially what that means is what percentage of what percentage of your property is currently what they call encumbered or locked up by a mortgage. So as a basic example, if you had a $500,000 property and you had a $400,000 loan, your LVR would be 80%. So the way that you work that out is you take your loan value, you divide that by your property value, and then you times that by 100 to sort of represent it as a percentage rate. And depending on your LVR is dependent on essentially the rate that you're paying from the bank. The lower the LVR, the better, really. But as a standard rule of thumb within the residential space, an 80% LVR is what you'd want to be able to avoid paying extra fees, such as sort of LMI or lender's mortgage insurance. There is other ways that you can get around paying that, but I guess the golden rule is by having at least 20% of your property that you own unencumbered or unsecured by a loan.
Yeah, and you mentioned different rates there. So I imagine that that's because the bank sees someone who has more than 80% of their property tied up in loans as higher risk than someone who may have less. Is that right?
100%. So say if these are just a basic example here. If you had an 80% LVR at the moment, the best rates you're really seeing out there is somewhere between the 5.3 and 5.4%. Usually 5.39, 5.4 is the best you're going to see on market for that. I mean, there's slight outliers there. Say if you had a very massive loan value, so say if you bought a $2 million property, and your lend on that is 1.6 million, generally you've got a bit of negotiation power to be able to bring that rate down slightly. But for the average person, that's the best you're going to see. But if you brought that down to a 70% loan to value ratio, so let's use the example of $1 million property, owing $700,000 for it, or the loan being 700,000, you'd probably bring that rate down to 5.14, 5.19, something like that. So you're saving sort of 0.2% just by reducing the perceived risks from the bank.
Yeah, okay. And I suppose that's where you can control the loan that you owe, I guess, is you're in control of what your payments are, whether you're making additional, you're not always in control of what the asset value is. So I'm curious how often you might see people who, maybe you've bought your house at 90% LVR, you copped your lender's mortgage insurance and you just paid it because you had no other options. You've had that home for a couple of years, you've been paying down the debt, maybe the asset value's gone up and you're thinking, well, hey, now I'm at 75% LVR. Is it worth pulling out some equity to do some renovations? And then, you go through the bank, everything's looking quite good. And then all of a sudden your property value drops for some reason. Maybe there's been market movements. That does affect your borrowing capacity because it affects your LVR.
100%, 100%. And if your property value has gone up or gone down, it doesn't really come into play unless you are refinancing. So that works sort of in both ways. So say if you've had your property for 5 years, your property's gone from 500,000 up to 600,000, and you've also been paying loan repayments for those 5 years, and you might now only owe 400 and let's call it 400,000 on this, 420,000, even though initially you had a 90% LVR and now you're at 70% LVR because 180,000 represents 30% of a $600,000 property. Your loan rate wouldn't go down to reflect on that. You'd still be paying the 90% LVR rate, even though the property value has gone up and your amount owing is reduced. You could only take advantage of that through refinancing and assessing under a new product. Now, this might be with the same bank, but generally there's different tiers of products through lending. Usually it's 50, 60, 70, 80, 90, and then 95, and having different rates offered by the lenders, respective of what the LVR is represented at.
Yeah, so I guess that's where you can sometimes get stuck with your current bank because you're only looking at the products they offer, all the services they offer. You're not necessarily considering the market, which again, that's where a broker comes in because they've got full access.
100%, 100%. The best line that I've heard about the advantage of a broker versus dealing with a bank directly is just as you put it. A bank will give you the best rate they have within their suite of products, where a broker's job is to find you the best possible rate on the market for your circumstances. Now, sometimes that might be the bank that you're currently with might actually have the best possible offer on the market for what you're trying to do. But that's why I find it really handy to go through a broker. Now, me personally, before I got into the broking industry, I obviously bought a home and I was tossing up between bank and a mortgage broker. But I ended up by going through a mortgage broker for one main reason. It was a single point of contact that I had there. And it was their ability to show me a number of options that are possibly available and have justifications why they're recommending one thing. And I thought that was a much more transparent way for me to be locked in for the next 30 or so years. I'd rather be able to really understand my options there.
Yeah. So just talking through LMI before, are there any other ways outside of your own deposit you put down that you can potentially avoid or minimize lender's mortgage insurance?
Yeah, there's a couple of different ways. So if you work within certain professional industries, some lenders offer LMI exemption up to 95%. So an example of that would be as a financial planner or as an accountant. The general rule of thumb there is if there's an industry professional body behind it, you would apply, this would be available to you. The other one would be around medical workers. So if you're a doctor or a registered nurse or an enrolled nurse, you can be available for exemptions. Though one way that a lot of people do it when they don't tick that box is through security guarantors or through guarantors. So that would mean if you have mum or dad who's got a property, whether it be unencumbered or they've got some equity available in it, is they go as a security guarantor to sort of make up that shortfall within the deposit to bring you below 80%. And then there's also some lenders now that are coming to the table with, there's actually only one lender that's recently come out with it, being Ubank, who's offering a 90% LVR OLMI, irrespective of what industry that you're working. You do pay a slight penalty rate from that. So if you remember, I said before, the best you're seeing is about 5.39. They're up around the 6.19%. Though it allows you to avoid paying lender's mortgage insurance. I guess I probably should step back though and sort of explain what lender's mortgage insurance is really. Really, what LMI is, or lender's mortgage insurance, is it's an insurance that you pay for as the borrower that purely protects the banks or the lender. So you're paying, generally is between $10,000 and $15,000 for LMI. And what that does is it provides a fund. So if something goes wrong and you can't make your repayments, it's insurance that the lender can claim to pay the shortfall of what they're owed versus what they sell the property for. So say if they're owed $500,000 and you they ended up by taking the property back, and they're able to sell it on the market for $450,000. That LMI, the bank would make a claim for that $50,000 to make up that shortfall, and that policy is paid for by you as the borrower.
Yeah, right. So you're paying that $10,000-$12,000 for that insurance premium, so that in the case that you can't make your repayments, they make the bank whole again.
100%.
Yeah, wow. So we've talked basics around. You've got LVR. We've talked lender's mortgage insurance. The concept of a guarantor, which effectively is just a guarantee for someone close to you that they'll also cover the mortgage payments. What else are some considerations that people getting new into property should be thinking about? Should we talk about principal and interest versus interest only?
Yeah, I think principal and interest versus interest only is another really key one to sort of understand. So principal and interest versus interest only is essentially the loan structure, similar to fixed versus variable. Principal and interest versus interest only is another split a decision you have to make. So principal is the initial lump sum that you're borrowing, and interest is obviously the interest that's being calculated daily by the bank. Principal interest payments represent you paying off a small percentage of the principal loan amount that you're taking, as well as paying some of the interest. Whereas interest only means that you're purely paying the interest component from the loan and not actually knocking down that principal. A lot of people, I guess you'd ask the question of why would you use interest only versus principal and interest? And it really comes down to what is the purpose of the loan. So a lot of people will take advantage of an interest only facility if they're purchasing an investment property, so that they're only paying the interest on it and they're relying on the capital gain or the growth in the property value in order to eventually sell that off and pay off that principal in full. Whereas if you're doing like an owner occupied or purchasing your own house, most people will go for a principal and interest in order to be able to be knocking off that money over time, unless they have the interest in reducing repayments, and sort of freeing up cash flow. And that's where an interest-only facility, even for an owner-occupied, could be applicable or could be advantageous for the owner-occupier to be able to pay that. In saying that, though, even with the principal and interest repayment, there's something you need to consider called the amortization schedule, which I'm guessing you'd be able to speak to a lot more in depth than I can, Josh, being a financial planner and working that out in the long run. But as a general rule of thumb, with the principal and interest repayment for a 30-year loan, you broke it up into thirds, so 3 10-year periods. So for the first 10 years, you're mainly just paying back interest. For the second 10 years, you're paying a mixed share of principal and interest. And for the third 10 years is where you really start to knock off that principal. And the reason for that is the interest owed for that first time period, while the loan value is so high, most of your repayment is going towards that interest payment. So let's say you've got a loan repayment of $1,400 or $1,500 a month. As a general rule, for the first 10 years, the interest per month would be between $1,100 and $1,200 based off the primary interest rates. And you can imagine if you're borrowing, for that example, it's about $240,000 that you'd be borrowing. Of repayments of $300 a month. It takes a whole lot of months to really start knocking that down.
Yeah, it's a good point. Yeah, I think a lot of people don't consider amortization schedules, particularly when they've had a house for 5 years and then all of a sudden they refinance to pull out equity, or switch lenders to get a better interest rate. And you think, let's just say you had a 30-year mortgage, it's got 25 years remaining, you then refinance with another bank to get a 0.25% interest rate reduction. Well, now a third of that 25-year period is largely spent on interest only. The second period of that is now about 50-50. So you do reset that schedule as well. Definitely worth considering. I guess talking
100%.
through, again, principal and interest versus interest only. We've had this conversation offline where the right option, it really depends. That is the best answer you can give, because if I've got a client who's buying property purely so that in retirement they own a couple of investment properties that are all positively geared, paying them rent so that they can live off that and buy groceries, well, they're probably going to want to do principal and interest so they own that property over time, versus someone who may be getting into property purely to negatively gear. For the tax deductions, you're going to sell that property every 5 years, pull out money and then go again. You're probably not going to want to be paying back principal and interest, because it's going to be a real burden on your cash flow. You're trying to keep it so that the rent is trying to cover as much of that liability as possible just to keep you flipping houses. So it really depends on what your goals and objectives are, which way you structure it. And that's not often, clear when you first purchase a property, because the most common way I've seen investment properties obtained in Australia, and I'd be curious to get your thoughts on this, is it's generally the first home that a couple buys together becomes the investment. So they buy a 2-bedroom house that they can afford. Next thing you know, they've got 2 or 3 kids. They've said, look, we've outgrown this home. Let's buy another one that's bigger. And rather than sell the one they've bought, they've said, well, let's rent it out because we've still got maybe emotional attachment to it. Maybe it's in a good location for when they do retire one day. And so they haven't necessarily thought about, well, should we have purchased that property in maybe the wife's name because she's not working, so that all the rental income's at her marginal tax rate, which you get up to $18,200 a year tax-free. Versus, hey, there was actually still quite a chunk of loan on that, which now that it's an investment, maybe the interest is tax deductible. Should we have instead had in the husband's name who's still working, earning a good income, and the tax deduction's quite high? So how you structure that loan in whose name is really important consideration as well when you're purchasing a property.
Oh, 100% agree. And I know if you're ever talking to a professional in this industry, whether it be an accountant, whether it be a financial planner or a mortgage broker, if their response isn't, it depends, when you ask the question of what's the best action thing to do, I'd always get my halters up or more question what their motivation is, because it is so individual. And depending on what as you said, what your goals are and what your personal circumstances look like as to what is the best route for that.
Yeah. And that's the thing, it's all about goals as well. So as an example, you might structure something in a way that maybe for the next 2 or 3 years, it's not advantageous to me, but because I'm keeping it for 20 years, the other 17 years actually is a bonus. So overall, you kind of weigh it up and go, well, I'm glad we did it that way. So it's not just about what are my needs now, it's looking ahead as well.
100% agree there. And that's where I think a financial planner really comes into play, to be able to put out that long-term modeling and really look at it from a step back approach. When I say a step back approach, is without the emotional attachment of what I want right now, and to be able to get down to crunching the numbers and to be able to really guide you with saying, all right, in this scenario, in 20 years time, this is what this looks like and this is what the end figure is, as opposed to, all right, I'll use the example that you gave before about do you want to put the property within the wife's name who isn't working and to be able to claim the tax-free benefit, or do you want to be able to use it in the husband's name who's earning a higher income for the tax deductibility in 5, 10, 15, 20 years? What does that look like holistically for your finances? And that's where you really need the guide of a professional within a financial planning industry to be able to do that modeling.
Yeah, definitely. It's very individualized. And again, advice that I give someone else might not be appropriate to their neighbours for that reason. I guess as a summary, we talked about loan to value ratio, or LVR, which is an acronym that gets thrown around. Another acronym was LMI, or lender's mortgage insurance, and some of the things that can influence whether or not you need to pay that. We also talked about how that works. Structuring is really important. So whose name to put a property in. We didn't quite go into depth on I guess other structures. We didn't talk about trusts, companies, things like that. Just keeping it simple for the everyday Aussie. So if people want to find out more information about you, Adam Mac, where do they go?
So there's a couple of places you can go. You look me up on LinkedIn. and have direct access to myself if you want some advice. Also have a YouTube channel called Adam Mac Mortgage Broker that I've just started out and going to be putting some more content on there just to be able to spread some advice within the industry and sort of give people a leg up to be able to understand the insights that we as a broker know versus what's general public knowledge.
Yeah, great. Awesome. All right, everyone. Well, look, if you found that useful, please like, subscribe, and we'll see you in the next one. Thanks, Adam.
Thanks, Josh.